City, this is Eric.
Give me Elliot.
City.
Hey, it's Will Emerson.
William, how are you?
I'm all right. How's the trouble and strife?
Busting my ass as always.
You see, that's why I tried to tell you, John. Why do you think I'm single?
I know you did.
The events that unfolded during and after the 2007 to 2008 financial crisis shed light on many fraudulent activities and conspiracies in stock markets worldwide.
Will continue on Wall Street.
Soaring gas prices, falling home prices, and rising unemployment.
It became evident that there were manipulations, insider trading, and other irregularities happening in share markets. Shares were being emptied, and a considerable amount of them were being sold off. Numerous such activities took place, and by the time auditors and regulators got wind of these issues, a significant amount of time had already passed. Despite the regulatory efforts, the stock market, even in today's scenario, is rife with rampant speculation and rule-breaking. In the midst of all these incidents, one trader has managed to stand out and break all the rules: Steve Cohen. He's not only made headlines, but has also earned not just millions, but billions in the bull and bear markets. Now, let's explore a trade that's garnered attention for its rule-breaking nature: the story of Steve Cohen's risky operations in the stock market. The narrative begins with Raj Rajaratnam, a highly known name on Wall Street. During the midst of the 2008 Lehman crisis, a handful of investigations were initiated against him. Federal agents were relentlessly pursuing Raj Rajaratnam, aiming to set an example that if anyone was engaged in insider trading or fraudulent activities, they would face consequences. Trading is not easy to escape once involved. Investigations were ongoing during this time, with federal agents interviewing prominent traders to determine their involvement. One name repeatedly came in conversations and discussions related to insider trading: Steve Cohen. Federal agents were perplexed, questioning why Steve Cohen's name consistently surfaced in connection with these activities. To understand Steve Cohen's story, we need to go back to his beginnings. Born in 1956 into a middle-class family in Long Island, New York, Cohen did not come from a wealthy background. Despite financial constraints, he showed a keen interest in finance from a young age. Fascinated by the markets, Cohen was sharp in academics, and he secured admission to a university in New York. While attending university, Cohen would read the Wall Street Journal every morning, determined to enhance his business skills. His passion for making money was evident from his childhood. After joining the workforce, Cohen engaged in two important activities. Firstly, he played poker, winning against friends and accumulating money. Secondly, he immersed himself in the financial world, driven by the desire to earn more. Cohen's financial aspirations led him to venture into the stock market. He combined his talents for speculation and gambling, amassing great wealth. However, there came a point when he realized that relying solely on speculation might not fulfill his ambitions. This realization changed everything for him. In 1978, at the age of 21, Steve Cohen decided to shift his focus from mere speculation to building a more substantial career in finance, a desire to achieve something greater. Steve Cohen, after graduating, joined a brokerage firm named Gruntle in New York. Despite the company's tarnished reputation due to alleged wrongdoings, Cohen utilized his skills to turn a profit. On his first day at Gruntle in 1978, Cohen earned a profit of $300,000, a significant amount at that time. But Cohen continued to refine his skills, eventually achieving extraordinary success. Within a span of a few years, he generated profits ranging from 60 to 80 crores in the volatile Wall Street market. His success was unmatched, leading to widespread speculation and curiosity about his trading strategies. The turning point came in 1985 when the Securities and Exchange Commission, the regulatory body, took notice of Cohen's activities. Despite skepticism in the market, Cohen's clear strategy involved options trading, and he was exceptionally skilled at managing risk and maximizing profits. When an attempt was made to investigate, it became evident that there was significant discrepancies. There comes a controversy. The SEC scrutinized his transactions and discovered many irregularities. Cass Cohen was engaged in insider trading, all while justifying his profits by claiming it was a result of skillful trading, which led to the regulator monitoring his transactions. The regulator claimed almost 70% success rates for his trades were based on gut feelings and insider trading. So, what was he really up to? Cohen was aware of an impending takeover of the electronics company RCA by General Electric. Anticipating a rise in RCA shares, he strategically acquired a substantial number of them. When the RCA shares indeed increased in value, he made an unexpected and successful investment, earning a profit of almost 140 crores. He boldly declared on Share Super that he had earned a profit of 140 crores, but when his skeptics asked for a verification through screenshots, he dismissed it as fake. Later, Cohen's lawmakers, who were strong in this case, received a big amount of money. However, Cohen got a clean chit in this situation, so whether he will always get a clean chit in the future remains doubtful. Moving forward, after 14 years of hard work and using insider information through his network, Cohen gradually transitioned from being a small trader to establishing himself as a prominent figure in the trading world as he was really ambitious. Despite being ambitious, his aspirations grew so much that satisfaction with millions was not enough for him. He aimed not for thousands or millions, but for billions. To achieve this, Cohen decided to open his own fund house and engage in trading. Before that, he had worked in Grantley, where he earned commissions but decided to leave. In 1992, he decided to take a leap of faith and started an electronics company named SAC Capital Advisors. The initials of the company came from his own name, Steve A. Cohen. Cohen initiated this venture with 170 crores and began fund management with a team of 9 people. They started making a mark in the fund management industry. Asset under management is a term used to describe the total market value of all the financial assets a company manages on behalf of its clients. Whenever they invested, the birth of a company's EOM, equity under management, occurred. As a result, Cohen's speed increased so rapidly that in 3 years, he raised his company's assets from 170 crores to a whopping 800 crores. Not only that, but every 2 years, SAC Capital, which was common at the time, witnessed a huge boost, reshaping the entire city market. The profits were soaring, and the new fund was on the verge of doubling. By 1999, the total capital had reached a staggering 8,000 crores, a huge jump from its initial 170 crores AUM. Cohen's company left the stock market questioning how such substantial wealth was accumulated in such a short time. The answer was simple. Cohen managed his entire venture not just with insider information, but also maintained transparency, operating seamlessly until 1999. As the story progressed, Cohen expanded his network, and with that, everything seemed to flourish. However, a twist awaited in the narrative. The era of computers had arrived, bringing with it increased transparency. Now, every detail could be monitored. People were curious about who was buying and selling, which stock was rising or falling. This transparency, facilitated by computers, prompted Cohen to question himself. He realized that to rise above normal traders, he needed to elevate his skills to a new level. He recognized that achieving such ease wouldn't be simple. It required special knowledge and the ability to decode patterns. Cohen devised specific criteria for selecting trades. For instance, if a president of a listed company stayed within the 300-meter range, you had a better chance of being selected by SAC Capital. As historical regulations diminished, Cohen decided to resign from the regulatory position. As a result, he was offered a package 4 times larger. Now, a vast network was being established, including company owners, ministers, presidents, and professionals from other big companies. Cohen had created an extensive network of traders to ensure that profit was the sole focus. By the year 2000, a new era had arrived, and by 2005 to 2006, Cohen had become a prominent figure in the world's richest individuals. His personal net worth had exceeded $10 billion. The team was doing exceptionally well, and a substantial amount of money was in circulation. Many such traders and investors making significant money were part of this phenomenon. Continuing with Cohen's journey, he started making significant moves. With abundant wealth at his disposal, he began purchasing yards, private jets, and large houses. However, Cohen's actions raised eyebrows among those who had been in the industry for a long time, and the SEC was doubtful about his capabilities from the beginning. In the middle of it all, SAC Capital faced a critical moment in 2006. A notice arrived at SAC Capital's office, alleging that Cohen had manipulated the market. The accusation was related to a stock named BioWhale, a Canadian drug manufacturing company, and Fairfax, a Canadian insurance company. Both had become subjects of insider trading. The allegations were submitted to SAC Capital, stating that false negative reports had affected the share prices and caused substantial losses to their network. The nightmarish situation escalated when the regulatory authorities kept a close watch on SAC Capital's managers. Despite the acquisition of insider information and the negative publicity, the acquisitions by SAC Capital cast a shadow of concern. Cohen was under scrutiny, and the regulatory authorities were keen on understanding how these people made money, what wrongdoings they were involved in, and whether any mental torture was being inflicted. The story took a turn when Cohen, alongside Matthew, a prominent trader at SAC Capital, took a keen interest in a drug named BAPI. It was anticipated that the release of this drug could cause havoc once it entered the market. Matthew and his team initiated discussions, and a confidential agreement was signed. The agreement ensured that all information discussed during the 2-hour phone conversation, which took place from an anonymous number, would never be publicly revealed. The situation got even more intriguing when discussions about the upcoming trials of the BAPI medicine unfolded. Dr. Matthews shared detailed information about the drug's trials, supplying Cohen with valuable insights. As the supply chain unfolded, the capital kept growing, and the astounding profit of 600 crores through long trades left everyone astonished. Matthew initially went long on this stock, but now his enthusiasm has grown even more to the extent that he considers making money by shorting the same stock. This sudden realization occurred because Matthew thought that since the drug in question had only around 50 million users, it wasn't necessary for everyone to have Sebel Plus. When information about the trial surfaced again, he shared it with the leaders, and they decided that action needed to be taken. Gradually, on July 20th, Matthews started dumping his stock and established a short position. The reality was that he already had information about BAPI's results. Through the entire short trade, he made 1,800 crores. Now, you see how extensive the quagmire of insider trading is. That's how all this information reaches insiders before it becomes public. The investigation had reached a point where the FBI is trying to figure out why and how they are involved in insider trading. In 2009, investigations into the FBI began, exposing SAC's business practices with considerable attention. This is because, for many years, no information had emerged against them. They are handling the situation aggressively this time, and serious efforts are being made to catch them. The focus is particularly on Cohen, as they have initiated full-blown employee insider trading. However, when the interviews began and regulators came in to conduct investigations, they started with junior traders. Junior traders are more vulnerable and can be easily exploited. As the investigation progressed, it eventually reached Cohen. Cohen is now being questioned by the FBI about the reasons and methods behind insider trading. In their pursuit, they've come across an individual named Jonathan Hollander, who worked on Albert Stone's, who was also associated with a supermarket chain. He constantly shared information about stock market prices, market trends, and trading strategies. Intrigued by his friend's success, an individual decided to audit monthly trades. He used to constantly inform them about all the stock market prices, what content is going on, how much material is there, what's happening, how it's going. Basically, what happened is that this man kept discussing with his friend and created some positions there. It's astonishing that he made substantial profits, around 50 to 60 crores, with the information he received before the quarterly results. When they started monthly trade audit, Cohen had created a system in his company that monthly trade orders would be internal within the company. The FBI had been instructed to keep an eye on every trade of SAC, but Cohen had not been caught yet because Cohen had created a system for himself. He did that for self-protection and asked the inside traders in his company that after the trade is over, they have to hang themselves out of time, rate it from 1 to 10, and write the complete logic in front. Whether technical analysis was applied, fundamental breakout occurred, volume breakout occurred, fundamental was applied, and so on. In this way, he had already created a predated record. He used to get a call with proof, so that if there's an investigation tomorrow, he can show that his traders did nothing. All they did was technical analysis. Now, along with the FBI, SEC was also behind him. In November 2010, a very big incident occurred. The Wall Street Journal, which is a very famous journal abroad, publishes an article that something big is going on behind the FBI. And in November 2010, a very big event happened. That something is going on behind the FBI. And now everyone thinks that the bubble is going to burst. The entire world of investigation gets caught up in this. Everywhere there is chaos, and it seems like now we're trapped, now nothing can happen. And then, in May 2011, Sydney and Dr. Matthew, who made money in the pharma company, was included in the US authorities' hit list. They smell something fishy. There's been some wrongdoing. They've been put out on the radar, and they need to be caught somehow. Information has been leaked from here in some way, and they need to be caught by any means. So, as part of the ongoing investigation, it's come to light that Matthew Maratoma, the individual involved in the pharma deal, had entered into a contract with Cohen sometime before the said activity. This suggests that prior to the decline in pharma stocks, Maratoma had likely conveyed insider information to Cohen, indicating his intention to engage in trading. But there was another contract between them, which caused Maratoma not to speak of all their inside business when he was finally caught. When Matthew Maratoma was taken into custody, he was immediately arrested because he confessed that, yes, I did insider trading, but he invoked the Fifth Amendment, seeking protection for himself, much to the surprise of those present. They had assumed that by pressuring him to implicate others, particularly mentioning Cohen in the investigation, he might receive a reduced sentence. However, they were bewildered as he steadfastly refused to name Cohen, and it appeared that his strategy was not aimed at diminishing his own punishment. Subsequently, there were rumors saying that Cohen might be covering all of his legal expenses and handling various contractual obligations. No matter what the cost, I'll cover it for you. But in August 2012, Matthew Maratoma got arrested for insider trading related to Bappy's case. Surprisingly, he never mentioned Cohen's name despite the FBI coming in. Everybody was shocked, thinking, why isn't he pointing fingers? It could help him. Investigators were also puzzled. Cohen realized that trouble could reach him any time. In 2013, he took matters into his own hands. He went to regulators and offered a hefty 3,000 crore penalty to settle his case on behalf of SAC Capital. Cohen understood playing games might not work, so he wanted a serious solution. However, the SEC didn't accept. They wanted to set an example after years of pursuit for all the fund managers worldwide, saying that if you cross us, you'll get caught eventually. The search for evidence continued. Finally, in 2008, they found an email against Cohen. Mike Steinberg, a big trader at SAC Capital, sent Business Figures quarterly results from his company's computer to Dell. The twist? These figures were sent before the official results, and the exact numbers were from Dell's computer. This trade made a profit of 15 crores. The SEC had the evidence, but his lawyers were given such hefty money, and Cohen's lawyers were so influential that they proved in court that Cohen only reads 10% of his emails, and he never read this email. But the SEC wanted to set a big example by revealing Cohen's inside business. Therefore, they thought, if they are successful, they will demand a bigger penalty. And they said, no, you have traded from your company, even if you're imaginary and not a culprit. A penalty of 7,000 crores is due. Basically, they wanted to somehow win this when they present such a huge number. 7,000 crores will make the opponent surrender. They thought that now he would bow down, but Cohen was not one of the losers. Nobody could do a thing against him, and he was calm and didn't even flinch. Then, to his advantage, the argument was made that he hadn't read the email, so the trade didn't happen. Not only that, he accepted the restrictions imposed on him, agreeing not to trade within that brand anymore. So, he established Point72 Asset Management, and his earnings skyrocketed, surpassing what he earned from the 1990s to 2002.